This accounting mini lecture covers the operating section of the statement of cash flows. Okay. In previous videos, we learned that when we use the indirect method of preparation for the statement of cash flows, in the operating section, we are going to adjust for changes in current assets and current liabilities. And the table here just provides us with a quick summary of how we're going to complete this adjustment on the statement of cash flows. So let's first look at current assets. If current assets increase, we're going to subtract this from net income. If current assets decrease, we're going to add to net income. If current liabilities increase, we're going to add to net income. And if current liabilities decrease, we're going to subtract from net income. Now, I know this may be a little bit confusing to look at first, but I think when we walk through an example, it's going to become a little bit more clear why we treat it this way. What we have to keep in mind is we are adjusting net income back to the cash flow that actually occurred related to operating activities. That means when we're looking at the changes in current asset and current liability accounts, we really have to ask ourselves, how does this impact cash flow? So let's look at an example, okay? Here we see an example of the statement of cash flows. And in this case, we're starting with net income of $38,000. Now, let's look at the items that we have adjusted for. These are our current assets and our current liabilities, okay? We had an increase in accounts receivable, which is a current asset, okay? We are adjusting this with a negative $20,000. Now, let's think about why this is negative, okay? If our accounts receivable increases, this means that fewer customers are paying us. If fewer customers are paying us, this has a negative impact on cash flow. Therefore, it's a negative number. Okay? Increase in merchandise inventory. This is also negative. Okay? Again, merchandise inventory is a current asset. Okay? If our inventory account increases, this either means that we are selling less goods or we have basically purchased more than we've sold. From a cash flow perspective, that has a negative impact, okay? Increase in prepaid expenses. It's the same principle, okay? We have paid for things in advance. That has a negative impact on cash flow, okay? Now, let's look at our current liability accounts. Decrease in accounts payable. That also has a negative impact, okay? Let's think about this. Accounts payable. This is where we record our bills that we owe, okay? If accounts payable decreases, that means we've been paying a lot of bills. If we've been paying a lot of bills, that has a negative impact on cash flow, okay? When you pay your bills, you have less cash. The same is going to be true for interest payable. It's the same principle. Now, let's look at an opposite effect here. Increase in income taxes payable, okay? If a payable account increases, this means that we have not been paying the bill, okay? Or we have not paid the bill yet. We haven't paid the bill yet. That has a positive impact on cash flow. Therefore, the increase in taxes payable has a positive impact. We see the positive $10,000. Okay, and here we also see summarized that we are going to also adjust for our operating items not requiring cash. This will include things such as depreciation, amortization. They list depletion here. Of course, that's only going to be applicable if we're in a business that uses natural resources. But depreciation and amortization are going to apply to most companies, and these are simply non-cash expenses. We're going to add those non-cash expenses back because they were subtracted out of net income. So therefore, if we do not add them back, we're going to be reporting incorrect cash flows because we didn't actually pay those items. We're also going to adjust for gains and losses reported related to investing and or financing activities. The reason we're going to do this is, again, those items were included in net income. On the statement of cash flows, we will be reporting them in the investing and financing activities. Therefore, if we don't back them out of the operating section, we would be reporting them twice on the statement of cash flows. So therefore, we're going to adjust them in the operating section so that we can report them in the correct section. Thank you for watching this video on the operating section of the statement of cash flows.